A credit score is one of the most important financial numbers in your life, yet most people never learn how it actually works. Imagine two people applying for the exact same car loan. They earn similar salaries, want the same car, and apply at the same bank. But one person gets approved instantly with a low interest rate, while the other gets rejected completely. Why? Because of three invisible numbers: a credit score. A credit score is basically a trust score for borrowing money. Banks and lenders use it to decide one simple question: can this person be trusted to pay money back? Your score usually ranges from 300 to 850. The higher your score, the safer you look to lenders. A low score tells banks that you may be financially risky, while a high score tells them you manage money responsibly. Think of it like lending money to a friend. If one friend always pays you back on time, you trust them more. If another friend constantly forgets or makes excuses, you become cautious. That's exactly how lenders think. Your credit score is simply a fast way to measure financial behavior. Generally, scores between 300 and 579 are considered poor. Scores from 580 to 669 are fair. Scores between 670 and 739 are good, and anything above 740 is considered very good or excellent. But here's something important: your credit score is not your income. Someone can earn a lot of money and still have terrible credit, because credit is mostly about habits, not wealth. Many people think credit scores only matter when applying for credit cards, but that's not true. Credit scores can affect almost every part of your financial life. If you want to buy a car, your score can affect your interest rate. Even a small difference in interest rates can cost thousands of dollars over time. If you want to rent an apartment, many landlords check credit scores before approving tenants. Better credit scores can also help you qualify for stronger credit cards with better rewards and higher limits. And if you ever want to start a business, strong credit can help you access financing more easily. So what actually affects your credit score? The first and most important factor is payment history. Lenders want to see whether you pay bills on time. Late payments can damage your score significantly. Even one missed payment can hurt. That's why automatic payments and reminders are so helpful. Consistency matters more than perfection. The second factor is credit utilization. This sounds complicated, but it's actually simple. It means how much of your available credit you are using. For example, if your credit card limit is $1,000 and you spend $900, your utilization is 90%. That looks risky to lenders, but if you only spend $100 out of $1,000, your utilization is only 10%, which looks much safer. Most experts recommend keeping utilization below 30%, and lower is usually better. The third factor is the length of your credit history. Older accounts help because they show long-term financial behavior. This is why closing old credit cards can sometimes hurt your score. Lenders like seeing a long history of responsible financial management. The fourth factor is hard inquiries. Every time you apply for new credit, lenders may check your financial history. Too many applications in a short period can lower your score temporarily, because it may look like you are struggling financially. The fifth factor is credit mix. Lenders like seeing different types of credit managed responsibly, such as credit cards, car loans, or mortgages. But this does not mean you should borrow money and necessarily never take on debt just to improve your score. Now let's talk about some common myths. Many people believe credit cards are always bad. That's not true. Credit cards are tools. Used responsibly, they can actually help build strong credit. The real problem is overspending and emotional spending. Another myth is that checking your own credit score hurts it. Usually, checking your own score does not damage it because it's considered a soft inquiry. Some people also believe closing credit cards always improves your score. In reality, Closing accounts can reduce your total available credit and increase your utilization percentage, which may lower your score. And finally, many people think only rich people have excellent credit. That's completely wrong. Excellent credit is usually built through consistency, discipline, and good financial habits, not income level. So how do you actually improve your credit score? First, always pay on time. This is the foundation of good credit. Late payments damage trust quickly. Second, keep balances low. Try not to max out your credit cards. Lower utilization often improves scores. Third, avoid applying for too many cards or loans at once. Too many applications can make lenders nervous. Fourth, keep older accounts open when possible because they help your credit history. Fifth, review your credit report regularly. Mistakes and fraudulent accounts sometimes appear, and fixing errors can improve your score. And finally, be patient. Building strong credit takes time. There is no magical overnight fix. Good credit is built through consistent, responsible behavior month after month and year after year. Here's something many finance videos ignore. Credit is emotional. Companies spend billions studying consumer psychology. That's why impulse shopping is so common. Swiping a card feels easy because you don't physically see cash disappearing. Many people use spending for a stress relief, boredom, social status, or instant gratification. But emotional spending often creates long-term financial stress. Financial discipline is not about never enjoying life. It's about making intentional decisions. Before buying something expensive, ask yourself one simple question: do I actually need this? That one question can save enormous amounts of money over time. Your credit score is not just a number. It's a reflection of financial habits. And the good news is that habits can change. Most people were never taught how credit works, but now you understand the basics. Pay on time, keep balances low, avoid reckless debt, and think long-term. Building strong credit is not about pretending to be rich. It's about becoming financially reliable, and over time, that reliability creates freedom, better opportunities, lower costs, and less stress. Financial freedom starts with financial understanding.